At the beginning of the decade, the gold price was an admittedly price-controlled $35. At the end of the decade, the price was $850. Now, I'm not suggesting that gold is going to go up 30-fold in this circumstance. I am merely suggesting that people who own gold, because they think it might go from $1,950 an ounce to $2,200, are missing the ship. You buy gold because you are afraid that it's going to go to 5,000 or 6,000 or 7,000 or 10,000.
RickRule, an experienced investor and speculator with over 50 years in the industry, is known for his insightful perspective on macroeconomic trends, viewing them through the eyes of a credit analyst. Rule's investment philosophy centers around the idea that gold serves as a valuable hedge against the twin threats of high inflation and economic uncertainty. In recent news, gold prices displayed a stabilization trend following statements made by Jerome Powell, the chair of the U.S. Federal Reserve. Powell's comments hinted at the possibility of more interest rate hikes, prompting market participants to await economic data as a compass for the future trajectory of interest rates. During this period, spot gold exhibited little movement, resting at approximately $1,914.99 per ounce. In relation to his insights, Rule has expressed his belief that the demand for precious metals, particularly gold, is on the brink of a substantial surge, potentially quadrupling its current levels. Recent data from the World Gold Council underpins Rule's assertions to some extent. In Q1 2023, global gold demand dipped due to reduced investor purchases, but central bank and Chinese consumer acquisitions balanced it. Q2 saw a 2% year-on-year decline in demand excluding over-the-counter transaction, primarily due to decreased net central bank purchases. Yet, overall demand, including over-the-counter transaction and stock flows, strengthened by 7% year-on-year to 1,255 tons. The official sector added 103 tons to reserves in Q2, aligning with the upward trend of central banks' gold interest. Gold bar and coin investment grew by 6% year-on-year in Q2, led by Turkey. Just before you watch the RickRule's interview and learn more about market trends, consider subscribing to our channel and give this video a big thumbs up. Rule suggests initiating exposure to gold through ownership in secure accounts at reputable storage facilities. Alternatively, investors can consider ETFs and certificates, which facilitate convenient online trading.
Precious metals as an asset class. It's important to understand this. Precious metals as an asset class comprise 0.5% of the savings and investment assets of Americans across the country. The 4-decade median is 2%. I believe that gold and precious metals assets will return to mean, meaning that demand for them will increase fourfold. I don't have any idea what the impact on pricing will be, but I suspect it'll be much more dramatic than other people think it will be. And Julia, the nice thing about gold as an insurance asset class, if you think about its price volatility, $35 to $850, or in the decade of the 2000 to 2010, $250 to $1,850, a 7-fold increase. If you think about that, if you had 5% of your net worth denominated in precious metals and precious metals related assets, if those assets increased in value 4 or 5 times nominal value in the course of the decade, that increase in value would shelter a lot of the losses that you suffered elsewhere in your portfolio. And that's what I'm asking people to consider doing. I measure gold in US dollars because I live in US dollars, and US dollars are a floating abstraction. So I suspect, given that, as an example, the dollar has lost more than 50% of its purchasing power since the year 2000, I suspect that everybody should start their gold portfolio by owning gold itself. The least troubling, the least risky way to own it. Own it in a segregated account, that is to say, gold held in your name at a storage facility that you understand, a Brinks, a Loomis, a Viamat, not in a vaulting facility owned by Schlepp, Schmuck, and Schmo, who might run off with your gold. Some people prefer to own their gold at home. I laughingly regard this as midnight gardening. That exposes you to a whole different set of risks, ones that people need to consider before they implement midnight gardening. I am not an enemy of the ETFs, or in particular the Sprott physical gold certificates, which are to say exchange traded, audited hoards of gold, where you control evidence of ownership rather than the gold itself. As I age, it is easier for me to own gold in surrogate form and trade it with the click of a mouse at much lower premiums than you pay for physical gold. If you are looking at gold as an investor rather than as an insurance product, you should look at the senior gold stocks. You have implementation risk and you have leverage both on the upside and downside. But this requires some risk and it requires some work. If you're a speculator, if you are attracted to the fact that the junior gold mining shares are some of the most volatile securities on earth, securities that can give you 10-fold or 20-fold returns in gold bull markets, understanding the risk and understanding the volatility, and you're prepared to do the work, understanding or differentiating between the good, the bad, and the ugly of the junior gold stocks, that's certainly very fertile ground. It's a business that's treated me very well. But most people can't stand the risk, they can't stand the volatility, and they aren't willing to do the work.
According to RickRule, the U.S. government's debt is substantial, officially at around $33 trillion. However, factoring in future obligations like Social Security and Medicare, this figure exceeds $100 trillion. Over the last decade, the U.S. government debt nearly doubled, reaching nearly $33 trillion, equivalent to 122% of the nation's GDP. Fiscal expenditure has surged since the pandemic and shows limited signs of slowing down. This trend has led to what market expert Larry McDonald calls a mind-blowing hole in the country's finances. The second concern RickRule raises is inflation. Despite an official report of 2.8%, this figure omits essentials like food, fuel, and taxes. When considering all factors, savings might erode by approximately 7% each year. In June 2023, U.S. inflation reached 3%, down from 4% the prior month, marking 8 months of continuous decline. In the same period, the Federal Reserve interest rate peaked at 5.08%, while the annual inflation rate accelerated to 3.2% in July 2023, ending a 12-month downtrend, yet remaining below the previous peak of 9.1%. Let's get back to the interview.
The top line number is that the U.S. government on balance sheet owes $33 trillion. That's with a T. That's 12 decimal point, 12 data points to the left of the decimal point. But that's not the worst of it. The net present value of obligations of the U.S. government, things like Social Security, Medicare, Medicaid, that adds over $100 trillion to the recourse liability of the U.S. government. So as Americans, we owe each other, or more precisely, the spenders owe the savers, something like $130 trillion. Putting that into perspective, about 5 times nominal GDP. And we propose to service that debt with a budget that's in deficit $2 trillion per year. That's the first part of the nervousness. The second part of the nervousness is inflation and the perception of inflation. The big thinkers of the world, Julia, the so-called rich men north of Richmond, would have you believe that inflation in the United States, CPI stated rate of inflation, has cooled to 2.8%. I beg to take issue. That 2.8% number doesn't include food or fuel. Your viewers will note from my girth that I like to eat. So inflation statistics that don't allow me to eat are of very little use to me in terms of calculating my basket of goods and services. But even crazier, and I want your listeners to listen to this CPI number doesn't include tax. The most important household expense in the United States is tax. It is greater than shelter. It is greater than transportation. It is greater than food. It is greater than energy combined. When I tried to do a sort of survey of the deterioration of purchasing power of savings in the items that made up my basket of goods and services, I found that my savings were losing purchasing power at about 7% compounded. I would ask your listeners to attempt to do an informal survey of their own. If then you assume that including tax, food, and fuel, that your savings buy you 7% less every year, let's look at the arithmetic around interest rates. The U.S. 10-year Treasury right now pays you about 4.2. In a currency that is declining in real purchasing power by about 7%. In other words, the U.S. government absolutely guarantees that they will make you 2.7 or 2.8% poorer every year for 10 years. Jim Grant calls this return-free risk. The combination of out-of-control debts and unserviceable debts with negative real interest rates on savers is, I think, the most important economic concern that Americans should have today.
With each flicker of fiscal instability and shift in inflation rates, gold's lustrous potential to safeguard wealth and offer respite from the tumultuous financial currents shines ever brighter. What do you think can the timeless allure of gold provide a steadfast answer to the uncertainties of our evolving global economy? Share your thoughts in the comment section. If you liked the video, don't forget to subscribe to our channel and tap the bell icon so you don't miss out on our upcoming content. Surprisingly, around 89% of our viewers haven't subscribed yet. We're aiming to reach 3,000 subscribers in the next 2 weeks, and your support could make a big difference. Thank you for being a part of our community.